So we're a week into the reporting season for the third quarter, and the results have been very robust. So in the S&P, we've had 65% beat on revenue and 80% beat on earnings, which has been very supportive for the market. The main sector that's really moved month to date has been the financials, and we've had some good numbers out of all the bulge bracket financials this week, with 85% beating on revenue and 90% beating on earnings. And that's that revenue beat that's so important, because it just suggests that the economic backdrop is improving more generally. And why is this? Well, we are starting to see earnings pick up, and here this is the S&P earnings forward-looking EPS expectations. Since the start of the quarter, we've seen quite a decent rise in expectations for the S&P, and that's because we've seen two big positive factors in terms of we've seen a stabilization of Chinese GDP. We've got another number this week that confirmed that, and that's a result of a very aggressive expansion of their monetary supply in order to stabilize that particular economy. And we've also seen an annualization of the deflationary influences of commodity prices and poor performance from the emerging markets, as you can see from these charts. So we're now in a position where, in the absence of a materially adverse effect, with global growth stable and that deflationary impulse from commodity prices out of the system, that we do expect to see a little bit more inflation. That pushes investors' perception and mindset away from the asset classes that are low volatility, long duration, which have done so well over the last few years, back into those areas of the market that will benefit from earnings growth. And that's a key shift in terms of market mentality that we're seeing. And that's coupled at the same time with what we think is probably the bottoming of the capital cycle, because we've more hawkish tones from the Bank of Japan, certainly from the Fed, and then this week from the ECB we saw a far more balanced picture, which we think probably is the precursor for tapering of their QE program. So the admission that negative rates are bad for the banking system, bad for pensions, bad for savers, and therefore spending rates, is starting to feed into central banks' programs, and therefore has major ramifications for asset classes and investor positioning. Going into next week, it's a very big week for numbers. We've got across the board major companies reporting, so we've got a very clear sense of how our growth stocks are doing. We had another good set of numbers from Microsoft last night, and also how our value stocks are doing, particularly the UK domestics, where there's significant nervousness around their current trading. So that's it from me. Thanks for listening.